October 24th, 1929, a day forever etched in financial history. While thousands of investors watched their life savings evaporate in what would become known as Black Thursday, I quietly executed the largest short position of my career. By the end of that fateful month, I had amassed over $100 million in today's dollars, all while the market collapsed around me. This wasn't luck. It was the culmination of decades studying market psychology and recognizing the unmistakable patterns of human fear and greed. In the next 45 minutes, I'll reveal exactly how I identified the warning signs of the 1929 crash months before it happened, and the precise strategies I used to profit while others panicked. These same patterns have repeated in every major market collapse since 1987, 2000, 2008, and beyond. The market speaks the same language across centuries. You just need to learn how to listen. I made and lost several fortunes throughout my career, but it was the 1929 crash that cemented my legacy as one of history's greatest traders. By understanding what I did differently from the masses, you'll gain invaluable insight into market psychology that remains unchanged today. Let me be clear. The market doesn't care about your hopes, dreams, or financial obligations. It's a ruthless mechanism that punishes emotional decisions and rewards disciplined strategy. I learned this through devastating losses early in my career that nearly broke me, both financially and mentally. When I walked the trading floor in 1929, I saw the same mistakes being made that I had made years before. Investors leveraged to dangerous levels, buying on margin with borrowed money, convinced the bull market would continue indefinitely. The euphoria was palpable. Taxi drivers and shoeshine boys giving stock tips. These were the exact signals I had trained myself to recognize as warnings. By September 1929, I had liquidated my long positions and begun building substantial shorts. My brokers thought I had lost my mind. The Dow had risen nearly 500% over the previous 8 years. Why fight the trend, they asked. But I wasn't fighting the trend. I was identifying its exhaustion. The signs were everywhere for those willing to see them. Trading volume had begun to decline despite rising prices, a classic divergence signal. Blue-chip stocks had stopped making new highs, while speculative stocks continued upward. Another warning. And margin debt had reached unsustainable levels. These weren't theoretical concepts. They were actionable signals that I had painstakingly documented throughout my career. When others saw endless prosperity, I saw the inevitable collapse of an unsustainable bubble. I will teach you to recognize these same signals that appear before every major market turn. The principles I discovered through decades of trading remain as valid today as they were in 1929. The technology changes, but human nature, the true driver of markets, never does. I made and lost 4 fortunes during my lifetime. In 1929, I shorted the market before the crash and walked away with $100 million in today's dollars. Not bad for a boy who started with $5 in his pocket, running away from his father's farm at age 14. I wasn't born wealthy. I didn't have connections. What I had was an uncanny ability to read tape, to see patterns in stock prices before others could. My first job was posting stock quotes on a board at a bucket shop in Boston. I'd watch those numbers all day, memorizing patterns, developing what I called my sixth sense for market movements. By 15, I was trading with my own money. By 20, I was banned from most bucket shops in Boston because I won too consistently. They knew I could see what was coming before they could. What made me different? I understood market manipulation before most knew it existed. I saw how big operators would drive prices down to shake out weak hands before a rally. I watched them push stocks up to lure in the public before dumping their positions. I didn't just observe these tactics, I mastered them. During my peak years, I would test market strength by placing small orders, feeling out resistance and support. If the market absorbed my selling easily, I knew it was strong. If it struggled with my buying, I recognized weakness. This wasn't guesswork. It was systematic probing of market psychology. I developed what traders now call the Livermore key point system. When a stock broke through previous resistance after multiple attempts, that wasn't just a technical pattern. It was a fundamental shift in supply and demand. I would pyramid into positions, adding as the trend confirmed itself. My biggest trades came from patience. In 1907, I sensed weakness in Union Pacific. While others saw a strong railroad stock, I saw vulnerability. I built a massive short position, and when the market collapsed, I made $3 million in a single day, roughly $86 million today. I wasn't just lucky, I was prepared. I kept meticulous records of every trade, analyzing my successes and failures with cold precision. My trading ledgers were works of art, detailed maps of market psychology. I understood something most traders never grasp. The market is never wrong. Opinions often are. When I lost money, I never blamed the market. I looked in the mirror. What truly set me apart wasn't just my ability to make money. It was my understanding of how the big players manipulated markets. I didn't fight the manipulation. I aligned myself with it. When I saw the footprints of major operators in the tape, I followed their lead rather than fighting them. My success wasn't magic. It was observation, discipline, and the courage to act decisively when others hesitated. Volume divergence has been the cornerstone of my trading success for decades. When I first discovered this pattern in the early 1900s, it completely transformed my approach to the markets. What is volume divergence? It's when price moves in one direction, while volume tells an entirely different story. This contradiction is where fortunes are made and lost. I look for situations where prices are making new highs, but volume is declining. This tells me that despite the rising prices, fewer participants are driving that move, a warning sign of weakness. Conversely, when prices make new lows but volume decreases, I see potential accumulation by smart money. These divergences signal imminent reversals that I've exploited countless times. During the northern Pacific corner of 1901, I noticed volume thinning dramatically as prices continued climbing. While others were caught in the buying frenzy, I recognized this divergence and positioned myself for the inevitable collapse. When the crash came, I walked away with profits while others faced ruin. The pattern never fails. Only traders do. My specific technique involves creating a simple ratio. Today's volume divided by a 10-day moving average of volume. When this ratio falls below 0.7, while prices make new highs, I prepare to sell. When it falls below 0.7, while prices make new lows, I prepare to buy. I don't act immediately. Patience separates professionals from amateurs. I wait for price confirmation before executing. I've refined this approach through multiple market cycles. In 1907, when the market was collapsing, I noticed volume drying up at certain price levels. This signaled to me that the panic selling was exhausting itself. I began accumulating positions against the crowd and captured the subsequent rebound for substantial gains. The beauty of volume divergence is its reliability across all time frames and markets. I've used it in stocks, commodities, and currencies. The psychology driving this pattern hasn't changed in over a century because human nature remains constant. Remember this: volume is the footprint of money. When smart money moves, volume speaks volumes. Most traders focus exclusively on price, which is why most traders lose. I focus on the relationship between price and volume, which is why I've made millions when others have failed. I don't follow the crowd. I watch what they're doing and do the opposite when volume confirms my suspicions. This single pattern has been worth millions to me throughout my career. Master it, and you'll have an edge few possess in any market condition. The second signal that's made me millions is what I call the pivot point trap technique. I've used this strategy consistently throughout my career to identify exactly when the market is about to reverse course. Most traders get caught in these traps. I profit from them. When I look at any chart, I'm searching for pivot points, those critical price levels where the market psychology shifts. These aren't just any support or resistance levels. I'm looking for points where the majority of traders are positioned on one side of the trade, creating the perfect trap. Here's exactly how I identify these pivot traps. First, I locate where multiple time frames show confluence. Daily, weekly, and monthly pivots aligning. When 3 time frames converge at one price level, I pay very close attention. The 1907 crash gave me one of my greatest victories using this exact method. I saw the weekly and monthly pivots align perfectly after an extended bull run. The market was setting a trap, and I positioned myself accordingly. Second, I watch volume patterns at these pivot areas. Most traders focus only on price, which is why they fail. I look for declining volume on approaches to pivots. This shows me the move is losing steam. Then, I wait for a volume spike in the opposite direction, the trap springing shut. During the 1929 crash, I observed this volume pattern for weeks before the collapse. The market was showing its hand to anyone paying attention. Third, I monitor the behavior of weak hands. When novice traders pile into a trend near pivots, they create the fuel for the reversal. I developed a specific technique to measure this. I tracked the rate of new positions opening near pivots. In 1923, I noticed retail traders frantically buying railroad stocks at resistance. I immediately took the opposite position and profited enormously when the inevitable reversal came. The most powerful aspect of my pivot point trap technique is its psychological foundation. Markets move based on fear and greed, emotions that repeat in predictable patterns. I've spent decades studying these patterns at pivot points. When I see excessive optimism at resistance or panic at support, I know the trap is set. Remember this: pivot points aren't just technical levels. They're psychological battlegrounds. When you master this technique, you'll stop being the trapped and become the trapper. I've used this approach to extract millions from the market while others wonder what happened to their accounts. The market always telegraphs its moves at pivots. Most traders simply aren't listening. I am, and that's why I win. Let me tell you about one of my most powerful market indicators, what I call volume price divergence. This signal saved my fortune repeatedly throughout my career. When volume increases but price doesn't follow proportionally, the market is telling you something critical. I've used this divergence as my first market tell since my early days in the bucket shops. In my trading career spanning over 3 decades, I noticed that volume precedes price. When I see unusually high volume but minimal price movement, I pay close attention. Something significant is brewing beneath the surface. This divergence often signals accumulation by large operators before a major move. I remember watching U.S. Steel in 1907. For weeks, trading volume swelled dramatically while the price barely budged. Most traders ignored this, focused only on the sideways price action, but I recognized the footprints of smart money quietly accumulating shares. I went long before anyone else saw what was coming, and when the stock finally surged, I was already positioned. The opposite pattern is equally revealing. When prices rise sharply on declining volume, I prepare for reversal. I saw this clearly in 1929. The market was making new highs, but volume was thinning. Most were blinded by greed, but the divergence told me the truth. The bull market was exhausting itself. I began shorting while others were still buying, and you know how that story ended. Here's my specific technique. I track daily volume against a 20-day moving average. When volume exceeds this average by 50% or more while price remains within a narrow range, I prepare for action. I don't move immediately. I wait for confirmation. The divergence is my alert system, not my execution trigger. I found that commodities markets display this pattern even more reliably than stocks. In wheat futures during 1925, I observed 3 consecutive days of extraordinary volume with minimal price change. I established a substantial long position, and within 2 weeks, wheat prices surged 15%. The key is patience. Most traders see unusual volume and jump immediately. I wait and observe. Is the volume persistent? Is it accompanied by price compression? Does it occur at key support or resistance levels? Only when these conditions align do I act with conviction. Remember this: volume represents effort and price represents results. When effort increases but results don't follow, something must give eventually. The market cannot sustain this imbalance indefinitely. Master this divergence pattern, and you'll see market moves before they happen, just as I did throughout my career. The second secret signal that made me millions is what I call tape-reading manipulation. The orchestrated movements designed to mislead amateur traders. When I was dominating Wall Street, I watched the ticker tape for hours, studying how big players move the market. What I discovered was revolutionary: predictable patterns of manipulation that signaled imminent price movements. I developed a sixth sense for detecting these orchestrated movements. When I saw a stock being deliberately sold down with increasing volume, I knew the big players were accumulating positions quietly. They wanted cheap shares before the real move. I didn't fight this manipulation, I joined it. When they pushed down, I bought. When they pushed up deceptively, I sold. In 1907, during the banking panic, I watched as Union Pacific was systematically sold off. The tape showed heavy volume, but something felt wrong. The selling was too orderly, too methodical. While others panicked, I recognized this manipulation and began accumulating shares. When the stock reversed sharply upward weeks later, I'd already established my position at bargain prices. That single play netted me over $300,000, equivalent to millions today. My technique for spotting manipulation was precise. I looked for divergence between volume and price movement. When volume increased but price barely moved down, smart money was absorbing the selling. That's when I bought aggressively. Conversely, when price rose sharply on declining volume, distribution was happening. Time to sell. I never traded based on tips or rumors. The tape told me everything I needed to know. The market's manipulated movements were like a poker player's tell. If you knew what to look for, the deception became obvious. In 1929, before the crash, I saw classic distribution patterns: stocks rising on decreasing volume, artificial support at key levels, followed by sudden drops. These manipulated movements screamed danger. I sold everything and went short. The result? I made $100 million when the market collapsed. You must understand this. manipulation still exists today, just in different forms. Dark pools, high-frequency trading, and options market makers create the same patterns I observed a century ago. The players have changed, but the game remains identical. To identify these orchestrated movements yourself, watch for unusual volume spikes without corresponding price movement. Look for stocks that refuse to fall despite negative news or rise despite disappointing earnings. These are the modern equivalents of the patterns I mastered. Remember, the biggest profits come not from following the crowd, but from recognizing manipulation and positioning yourself accordingly. The tape doesn't lie. You just need to learn its secret language. Secret signal number 3 is one I developed after being burned repeatedly by market manipulation through news. I call it my media manipulation detector, and it saved me millions over my career. The pattern is simple but devastating when you recognize it. I learned to track unusual activity before major news announcements. When I see volume increasing in a stock before any public news, I know insiders are positioning themselves. This isn't random, it's calculated. I've watched this pattern repeat across decades and different market conditions. In 1907, I made one of my largest fortunes by recognizing this signal before the banking crisis. While newspapers were still printing optimistic headlines, I observed unusual selling pressure from connected players. The smart money was positioning before the public knew what was coming. I went short and profited enormously when the crash finally made headlines. My approach has 3 components. First, I track abnormal volume patterns, sudden spikes in trading activity without corresponding news. Second, I monitor the behavior of industry insiders. Their actions speak louder than their words. Third, I pay attention to the tone shift in financial publications. When they suddenly change narrative, something's happening behind the scenes. Let me be clear. I don't try to predict the news itself. That's a fool's game. Instead, I detect the footprints of those who already know what's coming. The market always moves before the news becomes public. Always. During the 1929 crash, I observed how financial papers shifted from bullish to cautious language weeks before the collapse. Simultaneously, trading volume in certain stocks swelled dramatically. The smart money was exiting while telling the public to keep buying. I recognized my signal and positioned accordingly. The mistake most traders make is reacting to news after it breaks. By then, the opportunity has vanished. The real money is made by recognizing when prices are moving ahead of public information. My media manipulation detector requires discipline. You must separate market reality from media narrative. When CNBC is screaming buy, but my signal shows unusual selling pressure, I follow my signal every time. This approach requires patience and detachment. You'll often position yourself against public sentiment, which feels uncomfortable. But comfort and profit rarely coexist in trading. Remember, news doesn't move markets. Markets move ahead of news. My signal simply helps you detect when that movement begins. Master this pattern, and you'll be positioned correctly when headlines finally catch up to reality. Integrating these 3 signals creates the most powerful manipulation detection system I've ever developed. When volume, price action, and sentiment all align, I know with near certainty what the big players are doing. Let me show you exactly how I combine these signals to stay one step ahead of market manipulators. First, I look for volume divergences. When a stock rises on declining volume, I become immediately suspicious. This pattern told me to exit my positions before the 1929 crash. The market was rising, but the smart money was quietly distributing shares. The volume wasn't supporting the move. I saw this same pattern in 1907 and again in 1937. The principle remains unchanged today. Second, I analyze price action at key technical levels when a stock repeatedly tests a resistance level but fails to break through decisively. Manipulators are often accumulating positions. I made millions by recognizing this pattern in cotton futures in 1906. The market kept testing the upside, failing, then holding support. Most traders saw weakness. I saw accumulation before a massive rally. Third, I gauge sentiment through what I call the fool's headline indicator. When financial newspapers become uniformly bullish after a prolonged advance, I prepare to sell. When they turn universally bearish after a decline, I get ready to buy. In 1923, every newspaper declared the bull market over. That's precisely when I went all in. Now, here's how I integrate these three signals. When volume patterns show distribution, signal 1. Price struggles at resistance, signal 2. And sentiment is overly bullish, signal 3. I exit immediately, regardless of what my emotions tell me. Conversely, when volume shows accumulation, price holds support despite repeated tests, and sentiment is excessively bearish, I buy aggressively. This integrated approach saved me countless times. The key is patience. Most traders see one signal and act. I wait for all three to align. In 1921, I observed heavy buying volume, signal 1, and strong support at key levels, signal 2. But sentiment hadn't reached peak pessimism, signal 3. I waited. 2 months later, when newspapers declared no hope for recovery, I deployed my capital and multiplied it tenfold. Remember, one signal can be misleading. 2 signals increase probability. 3 signals aligned create near certainty. This integrated system isn't just about avoiding manipulation. It's about profiting from it. The manipulators create the very opportunities I exploit. Their actions become predictable once you understand this system. The third signal I rely on is what I call my volume divergence pattern. This pattern has saved me millions over decades of trading. When price moves in one direction, but volume tells a different story, pay attention. The market is whispering its secrets. I first discovered this pattern during the panic of 1907. While stocks were plummeting and headlines screamed doom, I noticed something peculiar in the trading patterns of Anaconda copper. The price continued dropping, but the selling volume was diminishing with each decline. The big players were quietly accumulating, not selling. I bought heavily against public sentiment and doubled my money within weeks. Here's exactly how I identify this pattern. I watch for situations where price makes a new high, but volume fails to confirm with its own new high. Or conversely, price makes a new low, but volume doesn't increase proportionally. This divergence signals exhaustion of the current trend. In 1929, I spotted this pattern repeatedly. The market was making new highs daily, but volume was declining on each rally. The smart money was distributing, not buying. I began shorting stocks aggressively, positioning myself for what would become the greatest crash in history. My volume divergence signal flashed warning signs months before the actual collapse. I don't rely on complicated indicators or fancy mathematics. I simply place volume bars beneath price and look for contradictions. When they tell different stories, I pay attention to volume. It shows me what the masses are actually doing, not what they're saying. Let me be clear about application. This isn't just about declining volume. It's about proportional relationships. If prices rise 5% but volume only increases 1%, that's a divergence. If prices fall 3%, but volume surges 10%. That's also a divergence. Both scenarios demand my attention. The most profitable opportunities come when this volume divergence appears at market extremes. When everyone is panicking and selling, but volume starts contracting on down days, I prepare to buy. When everyone is euphoric and buying, but volume doesn't confirm new price highs, I prepare to sell or short. Remember, the market is manipulated daily. Big players need volume to distribute their holdings. They need your enthusiasm to sell into and your panic to buy from. For the tracking volume divergence, I see through their games. This pattern works across all time frames, from daily charts to monthly. But the longer the time frame, the more reliable the signal. I found monthly volume divergences to be particularly powerful forecasting tools for major market turns. Master this pattern, and you'll start to see the market's true intentions, not just its price movements. Now, let me share what I consider my greatest contribution to trading methodology, what I call the Livermore manipulation matrix. This is where I combine all three signals we've discussed to create an almost unbeatable trading system. When price action, volume analysis, and market sentiment align, I found the probability of success increases exponentially. I developed this matrix after losing my fortune for the second time. I realized that relying on just one indicator was like trying to navigate the ocean with only a compass. Possible, but unnecessarily dangerous. The matrix works like this. I assign a numerical value to each signal based on its strength. Price action gets a score from 1 to 5, volume receives 1 to 5, and sentiment gets 1 to 5. Only when the combined score reaches 12 or higher do I consider entering a position. Here's how I applied this during the 1929 crash. By September 1929, my price action signals were flashing warning signs. The market made several failed attempts to break higher. I scored this a 5, extremely bearish. Volume patterns showed distribution, large blocks being sold on rallies with diminishing buying pressure, another 5. Market sentiment remained wildly bullish, despite deteriorating fundamentals. Newspapers were still recommending stocks. I scored this a 4, contrarian bearish. My matrix showed 14-15, nearly perfect conditions for a short position. I committed heavily to my short position and walked away with $100 million when the market collapsed. That's over $1.5 billion in today's money. The matrix protected me from false signals and kept me in the trade when others panicked. I found the matrix works in any market condition. During the 1921 bull market, I scored bullish price action, 5, increasing volume on breakouts, 4, and shifting sentiment from bearish to neutral, 3. With a score of 12, I went long and rode the entire trend. The real power comes from the discipline this system enforces. When I see a promising chart pattern, but weak volume and mixed sentiment, the matrix keeps me on the sidelines. This saved me countless times from what would have been losing trades. Remember, the matrix isn't about perfection, it's about probabilities. I never needed to catch the absolute bottom or top. I just needed to position myself where the odds heavily favored my trade. By combining these three signals systematically, I was able to achieve consistency that had previously eluded me. The Livermore manipulation matrix became my trading constitution, a set of rules I refused to violate regardless of how tempting the opportunity seemed, and that discipline, more than any individual trade, is what ultimately separated me from the amateurs. Let me walk you through a modern application of my trading signals using the 2021 Archegos capital collapse, a perfect case study of what happens when you ignore market warnings. While I traded in a different era, my principles are timeless, and this recent disaster proves it. I would have spotted the warning signs months before Archegos imploded. The first pivotal signal appeared in late 2020 when Viacom CBS and Discovery shares began their unnatural ascent. From my experience, when stocks move too far, too fast, without fundamental justification, they're being artificially manipulated. Viacom CBS rose nearly 700% from its March 2020 lows to March 2021. Precisely the kind of parabolic move that would have triggered my alarm bells. My second signal would have flashed in January 2021 when unusual trading volumes appeared. The market was telling me something wasn't right. I always watch volume as religiously as price. When a stock trades at multiples of its normal volume while continuing to rise sharply, someone is accumulating massive positions, often with leverage. This pattern repeated across multiple stocks in Archegos' portfolio. By February 2021, my third signal would have been screaming concentrated ownership. When I traded, I tracked who was buying what. Today's equivalent would be noticing that the same handful of brokers were facilitating massive block trades in the same securities. This concentration creates a dangerous imbalance, exactly what I warned about in my trading rules. March 2021 delivered my fourth and final signal, the secondary offering. When Viacom CBS announced a $3 billion stock offering to capitalize on its inflated share price, this was the market's verdict. I learned through painful experience that when companies rush to sell shares after abnormal price increases, smart money is heading for the exits. Within days, Archegos couldn't meet margin calls, forcing liquidation of over $20 billion in positions. The stocks collapsed, with Viacom CBS falling over 50% in a week. Had Bill Huang, Archegos' founder, followed my principles, he might have avoided disaster. I never allowed myself to become so leveraged that a single adverse move could wipe me out. I always maintained sufficient capital reserves. Most importantly, I respected the market's signals. The Archegos collapse reinforces what I've been teaching you. The market always warns before it punishes. Those warnings appeared in unnatural price movements, unusual volume patterns, concentrated positions, and finally, the company itself signaling overvaluation. This case study demonstrates why my trading principles have endured for over a century. The instruments change, the technology evolves, but market psychology remains constant. The signals are always there if you're disciplined enough to see them and humble enough to act on them. Now, let me give you a clear roadmap for your first 30 days implementing my pivot point system. I've refined this implementation plan through decades of trading, and it's designed to build your skills methodically without overwhelming you. Days 1 to 5. Start with paper trading only. I want you to identify 3 liquid stocks with clear trading ranges. Record their pivot points each day using the formula I taught you. Mark these on your charts with horizontal lines and observe how price reacts when it approaches these levels. Don't place a single real trade yet. Discipline begins before money is at risk. Days 6 to 10. Continue paper trading, but now add my volume confirmation rule. When price approaches a pivot point, verify that volume increases at least 50% above the 10-day average. I learned the hard way that price movement without volume confirmation is often a trap. Document each paper trade with entry point, stop loss, and target exit. Review your hypothetical results daily. Days 11-15. Begin trading with minimal capital, no more than 10% of your intended position size. I made my millions by starting small and scaling up only after proving my system worked. Focus exclusively on trades where price tests a pivot point with confirming volume. Set hard stops 3% below support pivots for long positions or 3% above resistance pivots for shorts. This mechanical approach removes emotional decision-making. Days 16 to 20. Analyze your execution quality. Are you hesitating at entry points? Are you moving your stops? I lost fortunes by second-guessing my system. The market doesn't reward wavering conviction. If you've maintained discipline, increase to 25% of your normal position size. Continue documenting every trade in your journal, noting emotional states alongside technical factors. Days 21 to 25. Implement my time-based exit strategy. Any position not reaching its profit target within 5 trading sessions gets closed, regardless of profit or loss. I discovered that time decay works against you psychologically. The longer you hold an underperforming position, the more likely you'll make an emotional mistake. Increase to 50% position sizing if your win rate exceeds 40%. Days 26-30. Begin full implementation of my complete system. Use proper position sizing based on account risk parameters. Never risk more than 2% of capital on any single trade. Review your journal daily, looking for patterns in your execution. The market will reveal your weaknesses through your results. Remember, I blew up my account multiple times before mastering this system. Your goal in these 30 days isn't massive profits. It's establishing the mechanical discipline that eventually leads to consistent returns. The market rewards process over outcomes in the short term. Follow this plan precisely, and you'll build the foundation for trading success that took me decades to discover. My legacy isn't found in history books or Wall Street museums. It's alive right now in the markets, in the same patterns, the same human emotions, the same opportunities that I exploited a century ago. What I want you to understand is that my methods aren't relics. They're your blueprint for today's trading environment. Here's your action plan based on everything I've taught you. First, establish your trading rules and never deviate from them. I've shown you how my discipline created fortunes and how my lapses destroyed them. Write down your rules today. Maximum position sizes, loss limits, profit targets. The paper these rules are written on will be worth more than any stock certificate. Second, master the art of patience. I made millions by waiting for the perfect setup, what I called the line of least resistance. In today's markets, this means identifying the primary trend and waiting for ideal entry points. The ability to sit quietly while others panic is worth $50,000 a year. Third, implement position sizing based on conviction. When I was absolutely certain about a market move, I pyramided my position strategically. Your modern application, allocate capital proportionally to your confidence level, backed by technical confirmation. Never risk more than 2% of capital on any single idea, a rule that would have saved me from my own destruction. Fourth, develop your market intuition through deliberate practice. I spent hours studying price movements until I could feel the market's pulse. Your advantage today: backtesting platforms and historical data. Use them to replay market history until patterns become instinctive. The screen time you invest now pays dividends for decades. Fifth, create your personal market journal. My trading records were invaluable not just for tracking profits and losses, but for identifying my psychological patterns. Your digital journal should document not just what you traded, but why and how you felt. Review it monthly to identify your weaknesses. Finally, respect market cycles. I navigated the panic of 1907, the crash of 1929, and everything between. Your markets will cycle too, from bull to bear, from mania to depression. Position yourself to survive the transitions. Cash is not just safety, it's ammunition for when real opportunity emerges. Remember this: the market will test you in ways you cannot imagine. It will find your breaking point, your greed, your fear, your need for action. But if you implement what I've taught you, you'll have what few traders ever develop: a system that transcends emotion. My life story serves as both inspiration and warning. Take what worked, avoid what failed. The rest is up to you.